first day of virtual learning. So let me just tell you where we are at. Um, right after we got back from spring break, we were supposed to start QuickBooks. But obviously, since we are not back together, we are not going to be starting QuickBooks until we do get back together, which I'm hoping is going to be in May. So we're just going to keep continuing with where we left off. So if you guys get into Classroom, you have these notes here, which are all about current liabilities. And that's where we're going to start today. So if you guys can get into Classroom and make a copy of those notes as I kind of refer to some other things, that would be great. So Chapter 9, 2 units ago, we talked about receivables. Receivables are when somebody owes us money. This unit is going to be the flip side, it's going to be on liabilities. So we're going to start today talking about current liabilities. And current liabilities are things that we owe that are due within a year. So the biggest portion of this is going to be accounts payable. But we can also have other things. For example, if we take out a notes payable, we could have a short-term loan from a bank, or even if we took out a 5-year loan, that first year would be considered a current liability. The rest would go in long-term liabilities. We could also have interest payable. So if we owe interest to a bank, that could go into current liabilities. Now, the biggest portion of a company's current liabilities is accounts payable. And you guys know what accounts payable is by now. So we owe somebody money for merchandise, supplies, something. So just like we learned about accounts receivable, if somebody doesn't have money to pay what they owe, that can be turned into a note. So we are going to take a look at turning an accounts payable into a notes payable. So in this example, we currently, and I'm going to try this, I'm not going to sure if it works. We currently have an accounts payable. Give me a second here. With a balance, sorry about my handwriting, of $1,000. We can't pay our bill. So we are going to turn this accounts payable into a notes payable. So the first thing we have to do is cancel this accounts payable, which you know that you do by putting this on the debit side. So on August 1st, we are going to cancel this accounts payable out with $1,000, and we are going to put it into a notes payable. Now, the advantage of the company giving us this loan is they are now going to be collecting interest, 12% interest per year. But since this is only a 90-day note, it's only a quarter of a year. So once the note comes due, we've got two choices. We can either pay it or we can dishonor it. In this instance, we are going to pay it. So before I pay it, let's figure out how much interest I owe. So it was $1,000 note. So $1,000, again, sorry about my writing, times 0.12, which is the interest, times 90 over 360, which is a quarter. You multiply this out, and I believe you get $150. So we are going to take this and now collect or pay our money. So the first thing we have to do is cancel out this notes payable. So on October 30th, we are going to get rid of our notes payable with a debit. So that cancels out $1,000. But we know we are going to pay it off with cash. The cash is going to be more than $1,000 because of this interest. So the cash is going to be the total of the note payable plus the interest, which is $1,150. Debits don't equal credits, and we know we have to add $150 to the debit side. Since we had to add this to the debit side, we've got a choice between a revenue and expense, and you guys know expenses are on the debit, so we are going to call this interest expense. So easy as that. I'm going to move down. We've got some practices here. So we are going to take a look at both the Bowden company and the Coker company. Bowden is the borrower or the buyer, and the Coker company is the creditor or the seller. So I'm going to start here. Bowden buys merchandise from Coker for $10,000. The terms of the sale is 210 and 30, and the merchandise costs the Coker company $7,500, which is why they're making a profit for selling it for $10,000. So let's record the buyer side first because it's easy. On May 1st, we buy stuff. That stuff is called merch inventory, and that's for $10,000. And since we didn't pay for it right away, our credit account is going to be accounts payable, and that's going to be $10,000. Now let's go to the seller side. We made a sale. So on May 1st, let's record the sale. Somebody owes us money, so that's an accounts receivable for $10,000. And that was because we sold something. So we're going to call this revenue account sales. Now we have to record taking stuff off of our shelves. So as a seller, there's always two parts to the transaction. So first part is always going to be cost of merchandise sold, which is the expense account. $7,500 is what it cost us. And then to take that asset off our shelves, it's merch inventory, $7,500. So that takes care of the first one. Now there are some terms here, 210 and 30, but we look down here, and when it came time to pay, which is within 30 days, so we didn't take advantage of the discount, we don't have enough money to pay. So we're going to have to turn this accounts payable into a notes payable. So again, I'm going to go over here, and we are going to do our accounts payable that we owe is 10,000. So we know to get rid of it, we have to debit it. So we're going to debit the accounts payable, and we are going to put it in a notes payable. So on May 31st, our debit is going to be accounts payable to get rid of that bill, and our credit is going to be a notes payable. Now, we do have some interest to worry about because if you guys take a look, it's 12% 60-day note, but we're not going to worry about the interest until after we paid it off. Now, from the creditor side, we have an accounts receivable. So let me sketch this out for you. Accounts receivable, 10,000. To get rid of that, we credit that. And so we're going to get rid of the accounts receivable with a credit, and we have to put it into a notes receivable. So on the 31st, we are going to debit notes receivable for 10,000, and we are going to credit accounts receivable for 10,000. Now, the Coker company is going to start charging interest. And it looks like at the end of the 60-day note, they decide to pay in cash what they owe. So we have to calculate some interest. So $10,000 times 12% interest times 60 divided by 360, which if you punch that in your calculator is going to be 0.1667. So you multiply that all out, and that is going to give you $200. That's how much interest we were charged. So because we decide to pay it on July 30th, we have to get rid of this notes payable. It's already paid off, but we know we're going to be paying more than $10,000 in cash. So cash is going to be our credit. It's going to be for $10,200, which is the amount of the note plus the interest. Now, since we have to add an extra $200 onto the debit side, we are going to call this an interest expense. Now, let's go to the lender side. On July 30th, we have to get rid of this notes receivable. To get rid of this notes receivable here, we have to credit it. And we know we're going to be getting cash, but we don't yet know how much. So cash is going to be our debit because we are getting cash. And we know that we have to clear out this notes receivable for $10,000 with a credit. And we know that the amount of interest we made is $200 right here. So since this is extra money that we made, we are going to call this interest revenue. And you guys know an interest revenue is always going to be a credit. So we've got interest revenue for 200, and so the amount of cash we're going to collect is 10,200. So that's kind of in a nutshell how this all looks. Now, let's look at taking a loan out from a bank. So we're going to go to a bank rather than turning an account into a notes payable. We're going to go to a bank and get a short-term loan. You guys can see it's a 90-day loan. It's 15%, but this percent is always calculated as a year. So we are going to go to the bank and get a loan. When you walk into a bank and take out a loan, what you are getting for this payable is cash. And it looks like we are getting $4,000 in cash. In exchange for this cash, we are agreeing to pay it back with a note payable. So we put this in as a liability of $4,000. Now, 90 days later, we are going to pay the note off in full. Now, before we pay it off, let's just do some quick calculations here. So, actually, I'm going to go up here and do it this way since I can't draw too well. So, I am going to take this $4,000 and I'm going to multiply it by 0.15, and I'm going to multiply it by 90 divided by 360, which you guys know is a quarter of a year. So you punch that all in your calculator, 4,000 times 0.15 times 0.25, and you are going to get $150. So this is the amount of interest that we are going to have to pay for this loan. So two things are going to happen with a loan. We're either going to pay it or we're going to dishonor it. In this example, we are going to pay it. So you know that we're going to pay cash. So currently we have a note payable. So in the amount of $4,000. To clear that, we need to debit it. So I'm going to go over here, and on December 18th, I am going to clear my notes payable of $4,000 because I paid it off. And I know I am paying off cash, but since there was interest charged, it's always going to be more than the amount of the note. So I have to take the amount of the note plus the interest, which is $4,150. Let me try again. Now, the difference between the debits and the credits, I can see that I need to add money to the debit side. And this we are going to call an expense. And since it's for interest, this is going to be an interest expense. So the only other thing that we're going to go through today is something called a discounted note. A discounted note is different. It is going to ask us to collect interest before the note is paid off. So, for example, in this example, we are going to take a $20,000 note. So we're going to go to the bank and take a $20,000 loan. We're going to walk away from the bank with less than $20,000 because it's a discounted note. So we're going to pay interest before we take out the note. So let's do some calculations. It's a 90-day discounted note, 15%, $20,000. So when we take out the loan is when we are going to pay the interest. So 20,000 times 0.15, which is the interest rate, times 90 divided by 360, which you guys know is a quarter. You punch this in your calculator, and you will get $750. So the amount of interest we are going to pay on this loan is going to be $750. But we are going to pay this at the beginning of the loan rather than the end. So I'm going to put this in August 10th as interest expense, $750. Now my note payable is the face value of the note, which I know that is $20,000. So the difference between my debits and my credits right now are $19,250. And that is the amount of cash that I'm walking away with. So the difference with the discounted note is that we pay cash before the note matures, before the loan comes due. Where most normal loans, we calculate interest after the loan is due. Most of the time, companies do this. When they are high risk companies. They don't have a very good record of paying their bills. So the bank is going to ask them to pay interest ahead of time. So you're going to do the calculations at the beginning of the loan. So when the loan comes due on November 8th, it's a really simple transaction. You are simply going to pay off what you owe. You don't have to calculate any interest. So we have to clear out our notes payable of $20,000, and we are paying off our cash of $20,000. Since we calculated the interest at the beginning of the loan, we don't have to calculate anything now. It's only at the beginning. So this is all that I want to go through now. You guys can see that there is a problem right here, 11.1a. My plan is I'm going to kind of video through the problem tomorrow, and I'm going to kind of walk you through how to do the different parts of the problem so we can figure all of this out. You are going to get a formative to do on Thursday that is very similar. My plan is going to be we're going to set up some sort of Zoom where you guys can do a question answer as you're doing your assignment if you guys have questions on how to do this. If you guys have questions anytime before that, feel free to email me. I will get back to you as soon as possible. Good luck, stay healthy, and hope to see you guys soon. See ya.